Welcome to the daily update, where I'll go over the action in the market for Thursday, May 30th, and then we'll see how things look for Friday, May 31st. We are turning negative in the short term. We're in the process of becoming more negative in the intermediate term. We're still positive in the long term, but we're coming to a point where some support levels are coming together. We have a big report coming out in Friday's session, the core PCE. We'll see if the market can react to that positively and bounce up off the support. If we fall through that support, things are going to turn even more negative than they already are. Now, a lot of folks pretty much expected the market to go up this week. We do have positive seasonality, and that's still there. But so far to this week, with one trading day left, we really haven't been seeing that. So I want to talk about something first, and I will put chapter marks in the video. I can do that on YouTube, but I can't do that on Rumble. I am getting ready to launch the program the first part of June, and I just want to go through and explain some things about what the program involves. For the month of June, the membership is going to be free. When things are finally locked down, it will be $97 per month. That's if you're a full member. Now, if you want to have early access to the daily videos and you don't want to be a member, that will be $19 a month, and that'll be starting in June as well. I'm still going to lock them down, but you don't have to pay the $19 a month. You do have to come over to Substack. I'll have a link that you can go to and be able to get free or early access to the daily videos. The weekly videos are still going to be available as posted. If you're a member, you automatically become an affiliate. Now, you don't have to take advantage of this. It's just something that's available to you. It's a way of trying to promote the program. If you know others who become involved, for every person you get involved, that takes care of half of your $97 each month. If you have two people that become involved and stay involved, that takes care of your membership program. So, and you can go beyond that if you want to try to generate some income for yourself. Maybe you like marketing and know a lot of people and you see value in the program and you want to promote it to others. As long as they stay a member in good standing, you will get half of that $97 per person. Okay. What are some of the things that are included in membership? First of all, you'll get early access or first access to the daily videos. I have been just making those freely available as I post them, like this video right now. But if you're a member or if you subscribe to get the videos first, you'll have access. And then once that video for that day, the market closes, it switches over and automatically becomes a public video at that point. I do have a lot of online courses, well over 100 hours when I take it all together. There is a course now on YouTube and Rumble where it was done about 3 years ago, and it's a basic course. It's designed for people that don't really know anything about the market or just want to have a refresher. I'm updating that in 2024, and that'll be the first course that's rolled out. Then I have a really lengthy course on technical analysis. I put a real emphasis on that, and where a lot of people that do similar types of strategies to what I do, they may not really rely on technical analysis that much. I do, and that has made all the difference. And this will be breaking things down. It's a pretty long course, and it'll be there. So if you're watching any of the videos and you're like, what is that indicator again? You can go back over and rewatch that video about that particular indicator. So it's also a reference book that you can use. Then I also have another course that talk about strategies. These can take advantage of the market when we go up or we go down or we go sideways. And then I have another course about mental analysis, coming to grips with fear and greed and all the different emotions that we go on, and having a better mindset so that your emotions don't control you, you control your emotions. And that's a very difficult thing to learn. Then I will at times have live online courses. This is where you are, I am where I am. And I may take bits and pieces of the various courses here and put them together into a course that's presented over a weekend or in evenings or some type of schedule that is set up. And then these courses will also be recorded, so you can go back and look at those. And then there'll be a community chat room. The idea right now is the room would pretty much always be open. Now, I'm not going to be there the whole time. I have, believe it or not, I do have to sleep. And there'll be times when I'm away or I'm busy. Like right now, I would be in the chat room, but I'm busy recording a video. So if you want to ask a question or maybe make a statement about what's going on, I haven't decided if it's going to be moderated or not yet. I hope not, because my personal opinion is that the people that become involved in this program are the best of the best, and you don't need to be moderated. You're adults and you know how to act like it. If you're not an adult, meaning that you don't know how to act that way, you're probably not going to last in the program for very long anyway. So maybe we can get by without that actually happening. And there'll be different things that I post, like I refer to this later, but there'll be usually a pre-market open short video, because there's many hours from the time I got done recording one day's video until the market opens for the next day. And I may go through and just say, this is how we're looking. We're looking at a higher open. This is what happened in Asia and in Europe. And these are the economic reports that are coming out, and just so forth. And then there may be updates during the day that you can also follow along. And this gives you a chance. Maybe you ran across an article and you can share that in this chat room. Or maybe you just have something that you want to express. So we'll just see how all that works out. And there'll probably be times when I'm the only person in that room, and that's fine too. It's there, and it's a resource that you have available to you, because I have a real problem with trying to have a conversation with folks on YouTube when you leave comments, because they get all out of order, and I'm not notified about that until I get an email. I don't know that is there, and there may be a long time has passed and you're trying to look for an answer. Well, this is going to be quicker, where we can try to do things in a more timely manner. It'll give you a chance to ask questions and then try to seek answers either from me or from others. But we want to keep it limited to what's going on in the program. A little bit of off talk is just fine, just because we're people and that's what we do. But we don't want to go blazing off in some different direction. And I'm going to really work hard to keep that more relevant. And then these are the video debriefs that I was talking about, in some way that every day I plan on doing a video and saying, okay, this is the model portfolio, the sample that we're looking at. These are the positions that we would have gotten into based on the plan that we have. These are the positions that we get out of, and just kind of review as things ended up happening. And we can also set up a time additional to this where we meet together and we come into a big room. I'm kind of moderating, more like a webinar type of a thing. And you can talk about different positions that you had and what you did right, what you did wrong. We talk about it. You have a way of saying, okay, I made a mistake on that one, or I really like what I did on this. I want to keep doing that. So it's just a way to learn. And then videos of live sessions. Typically what will happen is anywhere from 15 to 30 minutes before the market closes on days that we're potentially looking at executing some of the ideas. Now, I may not personally be doing them, but I'll have a whole list of different things that you may be interested in getting in at a particular time using the foundation of the program. Just for example, if we're looking to go long, and one of my rules is, number one, trade as close to the close as possible. Number two, if we're looking to go up, we don't get in on a down day. We buy into strength and we sell into weakness. And that's different than what a lot of people present. And so if we're looking to go long, meaning we want the market to go up, and we're down that day, then I might not do a live session as we get close to the close. So it just gives us a chance to kind of huddle together. You can look at your plan. We can talk about some things, and then you may be, if you decide to, actually entering some orders at that point. You can also talk about anything that closed, whether you had a profit or a loss at that time as well. And then different vlog posts. This is what I was talking about. These would be just one-way videos where I do a pre-market open, and then I might do possible additional posts. I may do text, I may do video. I'll probably do a combination of the two. It just depends on what I can do at that particular time and what I want to say. So that's another possibility. And then there's various supplemental videos that I've been doing some research on different topics that are outside of the program itself, but still highly related to the program. And those can be valuable tools that you'll have available to you. And then this is the sample portfolio plan. This isn't just something that you're going to blindly follow. If you don't understand a strategy, don't do that strategy until you feel really comfortable with it, because you're the one taking all the risk. And I try to set this up in such a way so that you really understand what you're doing before you do it, and then taking personal responsibility if you're wrong, but enjoying the benefits if you're right. This isn't a religion. I'm not a guru who's trying to spread my truth across the land. I'm trying to teach you information so that you can develop a skill and think for yourself in this whole thing. I'll also have what I call the daily journal and action sheet. This is usually one sheet long. It's a breakdown of our view on the market, strategies that we're interested in, positions that we have right now. All the rules are set up. This is what we're going to do if we see a profit. That's the percentage we want to see. This is what we're willing to risk before we get out for a loss. And it'll be a blank form that you can download and print out if you want to. I'll probably have two different versions of the form, one that's blank for you to fill out, and then one as kind of a sample that I fill out. And this is what I'll be going through when I do a video to talk about any updates in this sample portfolio. And then here's an email address if you want to send me an email. You like this, you don't like this, you think something should be different, what have you. You can also leave a comment either on YouTube or on Rumble. Okay, so now I'm going to put a chapter mark in right here, and we're going to go back and talk about what happened during the day. So right at the open, we had a gap lower open. The futures were pretty negative, and prices dropped down below S1 at 52.59. We got down below S2 at 52.51. We tried to rebound, but then we hit resistance back up at S1. So we just weren't able to bounce back up more than that. Prices then declined back down to S2, and then they kept dropping. We got all the way down to S3 at 52.32, and then we closed slightly above S2. We were down 0.6%. We're still below average with volume, even though it picked up a little bit. And we are negative now in the short term. We're turning negative in the intermediate term. It depends on your view. If some of the indicators and charts that we look at, we're already negative. Others, we're in the process of switching over to being more negative. We're in the long term, we're still positive for right now. And in Friday's session, it will be about inflation. We're going to get the core PCE, and then how is the market going to react to that? And that's going to also influence interest rates, which have really been a driving force behind pressuring stocks right now, because interest rates have been going up, even though they were down in Thursday's session. And then all the different geopolitical things, just in case something comes to the surface there. So we did have a day where the broad market actually outperformed the mega caps. That's what drug things lower. And this is kind of positive in a way, to have the broad market hold up a little bit better. So some of the indicators that were declining after Wednesday, now they're starting to turn back up a little bit, because it was the mega caps that really took things down. And I'll show all the charts to go through that. This is why we're turning negative in the short term. We have now closed below the 20-period moving averages with the S&P. We are getting to some support, and I have a number of different charts to show you that. And climbing interest rates are continuing to pressure stocks. On a short-term basis, we still have the stochastics, but those are coming down pretty quick. And the slope oscillator, which is below its moving average, but still giving us an extreme positive reading. We're already extreme negative with the Stoch RSI and the Williams percent R. These are short-term, very touchy indicators. So whenever we seem to have more than 2 days down in a row, sometimes even one day, these go either extreme positive or negative. The scenario has not changed. We'll see if Friday's session actually does anything to change that. The Fed is keeping rates higher for longer, and now the market's trying to figure out what does longer mean. And they're looking at September as possibly having a rate cut. I'll be going through over the weekend and doing the probabilities with how things are shaping up. And I was going to take this out, but the quantitative tapering that the Fed has been decreasing, that's pretty much gone. That's been baked into the market now. The dollar was down and interest rates were also down, but this may have given more support to the broader market, but it certainly didn't help the mega caps. We closed at 4.55% for the 10-year yield, where we had been at 4.62%. We're still inverted with the yield curves, and we're neutral still with sentiment. We're at 43, where we had been at 47. We're in a non-trending environment now. The ADX has crossed below 20. It's also turned negative. The red line has come above the green line. And so that just means we're in a non-trending environment. But if we default to anything right now, it would be negative because the red line is now on top. Our bias is negative with the down day, and I've switched our momentum to negative because we've been really shifting over more to this negative stance. Now, we could have a powerful up day on Friday. The market may react to the PCE report and really like that, the core PCE, and really be able to bounce up out of that. But the market's going to need to do something pretty quick as we're approaching this support, or things are going to really have the potential of deteriorating even more than they already have. The economic reports, I'm just going to read through these numbers. I do have some charts, but not for this. The advanced international trade in goods, came in at minus 99.4, which is more or down more than the minus 92.3 billion that we saw last time. Retail inventories were up 0.7%. Last time they were up 0.1%. Wholesale inventories up 0.2%. Last time they were down 0.4%. This is a chart that I will show you. Jobless claims came in as expected at 219,000. Last week, they were at 216,000. The continuing claims came in at 1.791 million. Last week, they were at 1.787 million. Not a real big change there. We didn't see much of a change with the headline number with the first quarter GDP second estimate. It came in at 1.3%, which is what they expected, but down from the 1.6% that we saw last time. This was the big one as far as inflation. The second estimate, we call it the deflator. It came in at 3%. Last time it came in at 3.1%, and that's what they expected. So this was actually a bit more friendly. We ticked down as far as inflation is concerned. Pending home sales were down 7.7%. They expected them to be down 0.5%, so that was quite a bit more. Last time they were up 3.6%. Here's some charts. Weekly jobless claims. We are seeing the moving average continuing to go up. That's the blue line, and we have been ticking up a bit, but we're not necessarily breaking out to the upside right now. This is just showing that even though jobless claims are increasing, they're not necessarily really increasing. And this is kind of what we're waiting for to see if we're going to go into a recession or not. It's the employment situation. If that really starts to deteriorate, that could be the final brick that weighs us down and actually has us go into a recession. And the fact that the employment situation has remained pretty solid has been another justification for the Fed to keep rates higher for longer. Here are the continuing claims. Also saw a bit of an uptick. We're seeing the moving average continuing to go up a little bit, but we've been flattening out for the most part lately. So we're not seeing any real drastic readings. So we take all of these together on a longer term chart. The red line are the initial claims. Then we have the continuing claims in blue and the latest unemployment rate here in black. Here's a further blow up to give you a little bit better look of how these are interacting with each other. Here's the real GDP and the deflator on a quarter over quarter basis. The blue line is GDP where it's coming down, and the deflator quarter over quarter is actually going up a little bit, but we're still not breaking out. We're a little bit above zero currently. Here's personal consumption year over year. It is declining just a little bit here. Net exports are going up just a little bit, but they're still negative. You notice over on the left, these are all negative numbers. We still export less than what we import. Real GDP year over year, it did decline from the previous quarter, but it's still looking positive. That's the takeaway for right now. Here are the pending home sales. They really dropped off in this latest reading where they had been up the previous couple of months. That's month over month. Year over year, we're also seeing a decline for right now. Here's some IsabelNet blog charts. These are deviations of earnings either above or below the long-term growth trend. The fact that this is going up, that means that earnings growth is actually increasing, and that's more positive for the market. But if we get pretty far away here, you see we get to some extreme readings and then something negative tends to happen. So that's why there's some question marks here. We're wondering, okay, is this going up a little too quick? Then this is exposure to bonds, as bonds have been under pressure for all of 2024. A lot of folks are not in them. So that's why we're seeing this number quite low. And then these are buybacks that we look at periodically. These are off the historic highs, but we're still seeing a lot of companies that are buying back their own stock. Then this is the consensus forecast as far as what they think the 10-year yield will be by the end of 2024. We're right up here right now, and they think that we're going to be at about 4.2%. So that would mean that we would actually come down from current readings to get to a reading that Bloomberg thinks will happen, at least according to this chart. This is folks that are in oil. As oil was really going up, we saw people really getting into that. Well, oil's been pulling back, and it's actually been under 80 and continuing to drop a little bit. So we may see this end up coming down. Copper, which had been really going higher, and it's kind of strange because that's one of the barometers that we use to measure the economy, and with it really going up, it's like, okay, the economy's looking good. Well, now that we see some profit taking coming in, and so some folks are starting to lock in profits with the copper. But then we have other parts of the economic cycle that we look at that are suggesting a weaker economy going forward. And these are small caps, been very frustrating in 2024 and coming down, but still you have folks that are into them, but it just hasn't lived up to what a lot of folks had really expected for the small caps. And then this is with with recent inflation relief, our risk appetite indicator is back to elevated levels. This is just getting a little extreme now. Folks were willing to take on a little bit more risk to a level that maybe this was getting out of hand as we were coming up out of the April lows into May. And I didn't find anything on Twitter. A lot of people are saying stuff, but nothing's really being said of any value that I could find and that I'm not already showing you here. Here's our intraday chart where we gapped lower. We opened below S1, immediately came down to S2. We dropped below S2. We were trying to claw our way back, but never really got a lot of momentum. We ended up hitting resistance at S1 and then dropped back down. We came down right at the close. We dropped below S3, and then we're able to close slightly above S3. Here's our intraday chart. Not anything different than what we're really seeing. We saw the futures weaker. Here's the cash session. And we're not trailing off too much. We're slightly negative in the pre-market session for Friday. This is encouraging, but not necessarily showing strength. The blue line is above the red line. That's positive. The negative part is the blue line is declining, and it declined less than the red line on the intraday chart here. We're also declining. We were seeing some hope here with growth of value. Well, a lot of that was given back in Thursday's session on the intraday chart. So we were down a lot more, where the last couple of days, like Tuesday and Wednesday, value was really under pressure. Now growth got hit on Thursday. So it was down where value was actually up. And we were up across the board with the mid caps, but growth was up less. We were also up less with the small caps. So we're not really seeing any improvement here with the small cap growth of value. It's coming back down right now. We're also seeing a decline with mid cap growth of value. And after we had been showing some improvement with S&P growth of value, now it pulled back. And we were kind of latching onto this, the growth of value ETFs that we follow. We were breaking out of the rainbow. Now we're starting to come back down. We did see discretionary bounce a little bit, and we can see here's the equal weight discretionary, and here's the staples, and then we do the ratio between the two. This is actually breaking out above its moving average, and it's not so much that discretionary is doing well. It's been recent weakness that we've been seeing in staples that have helped this ratio overall. Large cap growth is coming down, now showing some weakness after setting recent all-time highs. The Wilshire also pulling back, but still above its 50-day moving average. Here's our trend where we're seeing the red line crossing above the green line. So that has turned our trend negative based on this chart. We're also declining with the ADX and we're below 20. That means we're in a non-trending environment and we're below the moving average. We're seeing that same thing here with the short-term chart. The red line is above the green line. We're below the moving average and we're below 20. And we picked up with volume, but we're still below average when we look at our volume oscillator. And we're picking up a little bit here with the Ulcer Index, but we're still well below the moving average. We did get the latest reading from Investors Intelligence at 3.45. Now, this only comes out once a week, not like the other ones that we look at that update each day. And we are going back up with the VIX, both with the line chart and the bar chart. We got above the moving averages with the bar chart, but we ended up closing right on the moving average with the line chart. And we're kind of starting to go sideways here with the VIX of the VIX, where it had been picking up, and then we saw the VIX going up after that. Now we're chopping sideways. Maybe that will help the VIX calm down just a little bit. Not saying that's what will happen, just something to look for. The momentum of the VIX is starting to go up as we've been seeing more fear coming into the market. The MACD has now turned and is going up. The SKU index, we're still getting an extreme reading. We did drop. We're in the red area, and we weren't as high as we were before, but we're still camped out up here, meaning that the market is still expecting some kind of a big move, and that could be the core PCE report that comes out. We really shot up here with the equity put call ratio. This could have been some hedging going on ahead of Friday's economic reports, and we're going back up, and I added a line here. It looks like we bottomed out. And now we're going back up with the 5-day, and that is more negative with the equity put call ratio. And we really shot up here with the volatility risk premium. It had been rather tame below the band. Well, it really shot up, just showing there's also an increase of fear, according to this indicator. We actually ticked down with this fear gauge, but we ticked back up slightly with this other fear gauge that we follow. We did get the latest reading of the American Association of Individual Investors. They trailed off. They weren't as positive in the past reading than we were. The moving average is still going up, but we're more neutral right now. Our advanced decline line studies. This is where we're seeing a little bit of hope on a down day for the S&P. The advanced decline line based on price and volume ticked up. Not very much, but it went up. This is just showing the bigger stocks saw some weakness. The rest of the S&P saw a little bit more strength. And this is also what we're seeing. We're going down with the 5-period and 10-period. The new highs have been contracting, but they actually spiked up just a little bit in Thursday's session, and we saw a trailing off of the new lows. So looking at the moving averages, yeah, that's negative, but the fact that even on a down day, we saw an increase in new highs could be taken as positive. We are still below the midpoint here with our 19-day moving average study at advanced decline ratio. We came down below the midpoint with the 39-day, but we just barely got back above that. So shorter term, we're negative. More intermediate term, we're switching back a little more positive. This is something that I've been really holding on to as far as what's the smart money doing. This is accumulation distribution, which takes volume into the calculation. Yeah, we declined, but we're still above the moving average. So that it's not really falling apart, at least yet. This is also encouraging. We had a down day and the chicken money flow was up and the moving average is turning back up. So this is something positive to hang on to. The chicken oscillator is still declining, but still positive since it's above zero. We ticked back up with the cumulative NYSE advanced decline line. We also ticked back up with our regular NYSE advanced decline line. Also saw a little bit of an improvement here with the other NYSE advanced decline line. We ticked back up with common stock for the advanced decline line. We also ticked back up slightly when we based this on volume. We had been negative with the new highs minus the new lows for the NYSE just on a daily basis. That's why I brought the chart up yesterday. Well, we crossed back positive slightly, and we're looking a little better there. The cumulative price for the S&P 500 ticked up barely, and we barely ticked up for the cumulative volume measure. Not screaming positive, but on a down day to have this even go up is positive. We're seeing a little bit of improvement with our advanced decline line studies. We came down to the moving average and we bounced both with the NYSE common stock, the S&P. We came back above the moving average with the mid caps and the small caps. So even though it was a down day, we're seeing some improvement when we look at the advanced decline lines on the various indexes. Here's the short term, and I added another line in here because I draw these lines so they're far from perfect. But we're going from the October low up to these lows that we set back in April, and I could have adjusted that a little different. This is also 2 years. I've been using a 3-year version of this chart, and we got this P right in the way here. But we're coming down to the pivot point, and we're also seeing this trend line, and they're not quite at each other yet. But we're also seeing the 50-period moving average, and we're seeing all of them kind of coming together at the same time. So this could develop into some kind of a support level. If we break through that, that is really going to turn things more negative. We did tick up with volume, but we're still below average overall. The Stochk RSI is already extreme negative, and the Williams percent are just barely. It's minus 80. When it gets extreme, it's minus 80.48. And we're no longer extreme positive in the short term. Definitely, we're almost getting extreme negative with our short-term stochastic. We're declining, but right about at the midpoint in the intermediate term. We're still extreme positive in the long term, but we're rolling over and below the moving average, and we're dropping below our 20-period double and triple exponential moving averages, and the lines are now starting to roll over. We were hoping we could recapture that, but in the short term, this is turning more negative. We did tick up also here with the 20, 50, and 200. Well, we were flat with the 200. But the fact that, and this is calculated on the S&P itself, so this is somewhat positive. We are negative, though, with the force index. We drop below zero and continue to decline. And we're closing down just a little bit below the 20-period moving averages here. Take your pick, exponential or simple. We just closed a little bit below that. So that's turning the short term back more negative. Now, you could call this an area of support. We could bounce up off of that and start to go back up because we're not really far below these lines for the present time. And we're dropping a little bit below the midpoint now with the Keltner bands here when we measure standard deviation. That's turning more negative. Intermediate term charts, we're dropping below the midpoint with the balance of power. We're still looking more negative with the go, no-go system, and we're dropping below the midpoint with the highest high values. The TTM squeeze is no longer extreme and is declining with the darker shade of blue. And we fell below these 50-period moving averages with the double and triple exponential moving average study. We had been holding up in this area as support. Now we're falling back, or coming down below that, and that's turning the intermediate term slightly more negative. But we're still above the simple and exponential moving averages based on 50 periods. If we keep falling, we will be seeing if this provides support. The ease of movement is declining, but still above zero. The Erin didn't change, but it's still positive. And the McClellan oscillator for the S&P 500, after it had gone extreme negative, we saw just enough of a bounce to get us out of an extreme negative reading. That could potentially be positive, but the indicator itself right now is negative. So we're declining based on price and volume. This is more intermediate to even short-term, long-term. I know that sounds weird, but just look at the intermediate term and it kind of extended out a little bit. And we are still negative here based on price and volume. We ticked back up with the NYSE McClellan oscillator, and we never did get extreme negative here, but we're still declining with the summation index for the NYSE based on price and volume. We ticked up a little bit. This was one of the bigger warning signs. As we were going up with the S&P, the Swenlin trading oscillator was declining and actually went negative. We ticked up just a little bit based on price and a teeny tiny little bit based on volume. We don't know if this is going to lead to anything, but it's negative, but it could be showing a little bit of an improvement. We're rolling over with the PMO. When we look at the indicator by itself, we're not below the moving average. Where we have crossed below the moving averages based on price and volume and are declining. We had become extreme negative with the PMOs that are rising. We bounced up out of that. We're still declining with the buy signals and declining with the PMOs that are above zero. We're negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're still extreme positive with slope, but we are declining below the moving average. The MACD is now starting to cross below its moving average. So we're turning more negative in the short term with the slope and TSI. We're dropping below the moving average with the MACD. The PMO isn't quite crossed yet. We're dropping below with the PPO. We're rolling over, but haven't hit the moving averages yet with our longer term oscillators. And we're coming right down to the 20-period moving averages. Will this provide support, or are we going to slice through these and start heading down to the 50-period moving averages? We're declining, but still positive with the bullish percent index. We're above 50. That means it's positive, but we're declining. So obviously that's negative. We're declining, but still above 50 with the NYSE bullish percent index, but we have now turned negative. We've dropped below 50 with the NASDAQ 100 bullish percent index. Seeing recent all-time highs being set and seeing this going down, that's a bit of a concern with the big stocks. The money flow is declining, but still above 50. We turned negative after yesterday. We continue to be negative with the ultimate oscillator. The vortex is still positive, but the green line's coming down and the red line's coming up. And we're still above 50 here with the RSI 14. When we stay up in 50, that means good momentum. Well, with the 9-period shorter term, we've dropped below 50, so that's turning the short-term momentum more negative. We declined, but still above the moving average with on-balance volume. We ticked up just a little bit with the stocks inside the S&P above their 20-period moving average. But we're negative since we are below 50. And here's our study. And we came down to some pretty low readings even after we saw the thrust. So not all hope is lost looking at this chart. We'll have to see, are we going to develop more of a negative momentum, or have we just seen a short-term pullback? We'll hit some support and then bounce up off of that. We ticked up a little bit with a 50-period moving average study, but we're still below 50, so that is negative. And we're no longer below 50 with the 100-period moving average study. So this has actually turned back somewhat positive. And we ticked up with the 200, showing a bit of an improvement there. The Copic curve is negative. The Sean trend meter is no longer extreme positive. And I added some support and resistance. This is the mini rainbow that I developed a long time ago. When we're going up and coming down, one of these lines will often provide support. We're wondering if that's going to happen. Right now, we're inside of the rainbow. If you're more positive, you want to see us bounce up. If we're turning more negative, we're probably going to fall down below this little mini rainbow. And I just want to have the fib retracements chart ready, going back to the all-time high, but we're still quite a ways away from even the 38.2% retracement level. We're looking more negative with the Heiken Ashi, with the dark candles. We're still positive, but pointing down with the Kigge chart. The Renko doesn't realize anything's happening, and the 3-line break is still rather giddy with bullish delight. Longer term, we're below the red line, both with the 150 and 200-period moving averages. And we don't know if we're coming up to a 50-day cycle or not. Just look at this more as informational. I tried to check the date. It's still coming up with June 4th. So that would be Tuesday in the upcoming week. But this could change. It could change the date around as we get closer. We do not have a confirmation yet with the Hindenburg Omen. What we're waiting for now, we saw one spike, and within 20 days, trading days of that spike, so roughly a month, we need to see another spike if this is a valid signal. And we're looking negative with the mid caps and the small caps in the short term. We're still positive with the other indexes. We're negative across the board with bonds based on price. We're negative with commodities in the short term, and the dollar is seeing a little bit more weakness in the short term. We're still positive with all the different models here with the decision point scorecard. We started off looking, well, not really positive because the dollar had a bullish MACD crossover, which is pressuring stocks. Canada got above 22,000. But then the rest of the day, that's when we start to see we cross below 105 after having a MACD. The dollar's kind of mixed up right now. A lot of this was the NASDAQ just dropping below different levels as the day went on. Now, this is not really encouraging right now because the two areas that we want to see doing best that give the most support to the S&P, communication and tech, they were the areas that were down. All of the other sectors ended up being up. Now, one area of positive thing is here that discretionary ended up being positive, even in it outperformed almost double, more than double how staples had performed on Thursday. This is a longer-term negative divergence that we're seeing when we look at the equal weight S&P versus the QQQ equal weight. We did not set a new all-time high with either of these measurements. So that's a negative divergence that we've been following. And we ticked back up slightly with the equal weight, where we were coming down more with the S&P. So we saw this ratio coming down. It really spiked up after Wednesday. It's coming back down slightly after Thursday. That just means the broader market held up better. The Dow's just under a lot of pressure right now, coming back down to these previous lows that we were seeing in April. We dropped below this pivot point. We're dropping below the 50-day moving average. This is not looking really good at the present time. We are negative with the Elder's Impulse system for the diamonds, and we're dropping back with the NASDAQ. We just about got up to this pivot point and have been coming down. We're still above the 50-day moving average, and we still have a pivot point even above the 50-day moving average. The NASDAQ 100 also seeing some weakness, but we still have a pivot point and the 50-day moving average below, which may act as support. We're negative with the QQQs, with the Elder's Impulse system. We're rolling over. We're just barely positive with the momentum for the NASDAQ 100. If we cross below the moving average, that's going to turn the momentum negative. We're still positive here. We're coming down to the 20-period moving average with the QQQs, where we've already fallen below that with the S&P. We haven't quite fallen below that here. And as long as we stay above both of these lines, that continues to help them go up. Now, if we start falling below these levels, that will turn things more negative. The small caps ended up being up 1.21%, but just bouncing around in this range that they've been in 2024. They're still negative with the Elder's Impulse system when looking at the small caps. With the Russell 2000 small caps, we came back up, but we're still under 50 with the RSI. We got back above the 50-day moving average, but the momentum is still negative for the small caps. The mid caps, again, we're watching this to see if it can provide some kind of support. It did last April. We really didn't hit this pivot point yet. We came right back up to the moving average. So we'll see if we're seeing any kind of strength in the mid caps. But they still remain negative when looking at the mid caps for the Elder's Impulse system. Apple was up a little over 0.5% and hanging in there for the time being. Tesla was up almost 1.5% and above its 50-day moving average, but still in a downtrend. NVIDIA, actually, I didn't think this was possible, but people actually took some profits in NVIDIA. It fell back. Microsoft is coming back down to its 50-day moving average. It saw 3.33% decline, and so that's kind of negative there. And we're having trouble with Meta actually getting above its moving average. It ended up being down over 1.5%. Amazon was also down almost 1.5% and dropping a bit below its 50-day moving average. Google was down over 2%. See, this is why we saw the S&P and the NASDAQ 100 going down. Netflix was also down about 1%, still looking a little better, but has not come back to its previous all-time high. The FANG index, after setting recent all-time highs, did see a pullback of 1.81%. The financial sector bounced back up and is now coming back up to its 50-day moving average. We saw this ratio ticking back up. To be more positive, we want to see this ratio going down. When this is going down, that means staples are underperforming tech. When this is going up, that means that staples are outperforming tech. And the dollar still in an uptrend, but it fell back under the 105 level. Internationally, we ticked up just a little bit with our short-term relationship, still showing it pretty strong with the longer-term relationship when we look at the S&P and compare it with the world index. Staples coming down to their 50-day moving average and did bounce up off of that. Will this end up providing support and bounce even more than what they have? Utilities were also up after seeing some recent profit taking. Healthcare was virtually unchanged and has dropped below its 50-day moving average. We're watching utilities, staples, and healthcare. These are the main defensive areas. If they're doing stronger, that is what often happens before the market is getting ready to decline. So that's why we're watching this. And then energy is kind of the variable. Sometimes it's more of a defensive thing. Other times it's just a flat out. It can go up and the market can go up at the same time. The total US stock ETF was down about 0.5% and has still not come down to its 50-day moving average. We were down with the 10-year based on yield. We were up with the 10-year based on price. We turned down just a little bit with our QQQ to S&P 500 ratio, but we're still above the moving average, and the moving average is starting to go up. We saw a bit of a bounce, but we're still declining. We're seeing a declining moving average when we look at discretionary versus the S&P. And we were seeing some improvement here with large cap growth to large cap value, but it pulled back on Thursday. So we're still above the moving average with the large caps. We're falling back below the moving average with the mid caps and the small caps. We're still not extreme here anymore with the 10-day average of the S&P 500 highs minus the lows. We dropped out of this range and we're still in that range. So it's looking a little more negative. We're still below zero with the 19-day advanced decline ratio based on price and volume, even though it showed a little bit of an improvement. And we're ticking back down just a little bit with S&P to utilities. We want to see this ratio going up to be more positive on the S&P. And we're ticking back up here as well with staples to the S&P. We want to see this ratio actually going down. So what's our outlook for Friday? We're turning negative as this weakness that we've been seeing continues to develop. Now, it could stop. I mean, we could get a positive reaction to the core PCE, but we could also get a negative reaction. So there's some things that we can latch onto that are positive right now, but we have to go with what our charts are telling us, and they are turning more negative. We do have positive seasonality for this week, but it just doesn't seem to have mattered at all. We're going to get personal income and spending and the core PCE. That's the big one. And we're also going to get Chicago PMI. We want to keep an eye on the different crazy things going on in the world. And here's, as we finish out this week with the economic calendar, this is also showing what they're expecting as far as the core PCE in Friday's session. Seasonality not looking really good for May 31st, but we've seen some positive days that were negative. Maybe some negative days will be positive. We're down with the Dow. We're only up 33.33% of the time, or we're neutral to negative with the S&P and the NASDAQ. Then we look at the green dashed line here. We're coming into the last trading day of the month. This is positive seasonally because this is what measures what happens during an election year. Friday is one of the more positive days based on what happened in 2023. We could potentially be coming into some positive seasonality once we get out of May and then into June. That is often helpful for the big tech companies. And I'll have another chart to show you here in a moment. Carson still has us seeing positive seasonality into the end of the month. And this is one of these things where we're up not even 4% now in the month of May. And that's after Thursday's close. But Carson put this thing out saying that if we're up 5% in May, that's a very good thing. Well, yeah, but we're not up 5%. We're up a little under 4%. And looking out into June, where we want to keep an eye on the first few trading days, we do tend to see positive seasonality. June tends to be more positive, going back to 1950, looking at election years. We're up 15 out of 18 times. We're down 3 out of 18 times. And after this video, I'm probably going to stick this chart over in the weekly version. This one is just showing typically during a presidential cycle that June, July, and August, we tend to have pretty good returns during an election year. Tom Bowley still is suggesting, according to his research, that we see some positive seasonality, even though we have not seen that this week. So the warning signs, the advanced decline lines, they are weakening, but they bounced up a little bit from their moving averages. So yeah, they're showing some weakness, but the fact that they're going up, even with the S&P and NASDAQ 100 down, is positive. We did set recent all-time highs with staples and utilities being strong, and that is a warning sign. That's typically what the market does before it gets defensive. That's why we're also watching energy and healthcare. Growth of value, it had been improving for the S&P, but it's not really getting all that convicted right now. The same thing, we saw a bit of an improvement with discretionary to staples, but we've seen that before, only to have it give it up in the next trading session. We are no longer extreme negative with the McClellan oscillator for the S&P, so I should have taken that out. But we did bounce from those levels, both for the NYSE and the S&P. Our oscillators are now turning negative. We're crossing over in the short term. We're turning negative in the intermediate term, rolling over, but haven't turned negative in the long term. We're negative with the Swenlin trading oscillator, but we bounced up just a teeny tiny little bit. You need a magnifying glass to see it, but we did. The parabolic SAR is negative. The slope oscillator is below its moving average, and it's still extreme, but it's coming down. The ultimate oscillator, the Copic curve, are both negative. We didn't We're not below the 100 period moving average study, but we're still below the 20 and 50. The equity put call ratio based on 5 periods is still going up, and the summation indexes are declining, and we've now turned negative with the bullish percent index for the NASDAQ 100. Positive signs. We're still above 50 with the bullish percent index, even though it has been declining. Chicken money flow, to have this go up on a down day and the accumulation distribution, yeah, that's a smart money indicator. Now, we have to see more follow through. We have to go with what price is telling us, but that, at least as of Thursday's close, is a bit encouraging. The Chaikin oscillator, even though it's declining, is still positive. The money flow, the vortex, the green line's coming down, but it's still positive. And we're still barely positive with the momentum for the NASDAQ 100. Financial sector coming back up to its 50-day moving average. So our conclusion, we're turning more negative as this weakness is starting to develop in the market. We're wondering if that weakness is going to continue to develop, but we are positive on a seasonal basis. We've turned negative in the short term, but we do have positive seasonality. We're turning more negative in the intermediate term as we're seeing more weakness. We're still positive in the long term. Thank you. I really hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.